So if you're in the building trade, you actually have a lot going for you right now. According to this article from CNBC, the happiest job in the world is the building trade. You get to see the fruits of your labor, but there's more than that. You won't find the happiest workers toiling away at the desks. Chances are they're working outside. Construction workers have the highest level of self-reported happiness than any other major industry category. If you're in the building trades, you know this. Sure, it's hard work and you have to lift things and it's physical labor. But this day and age with modern equipment, tools, hydraulics, even cordless nailers, it's not the same type of job as it was that broke the backs of your grandfathers. And right now, there's even more going on in the industry that makes it even sweeter. We know certain developers that are paying $70, $80 an hour for construction workers, site workers. So not only is it happy, but it makes a lot of money. If you're in that industry, it's important to know what's going on behind the scenes. Well, here's a very underrated real estate industry event that's happening. It talks about mortgages. And the first thing it says, mortgage has a jump in closing costs. Well, that's not the big punchline. We'll get to the big reveal in a minute. And this comes from the CFPB, the Consumer Financial Protection Bureau. It's a government agency that oversees the mortgage industry. So closing costs went up. So if you refinance a mortgage or you buy a new house, you have to pay closing costs to the mortgage company. It's a one-time fee paid at the time of the transaction. Those have gone up. There's also denials for insufficient income. We'll come back to that one. But here's the big one. Growing proportion of cash out refinances. This is very, very serious. I don't think people should overlook this at all. When you refinance a mortgage, for those of you who know this, I apologize in advance for being redundant, but it's a good refresher. Let's say if you buy a house and you pay $250,000 for the house, and you put down $50,000 and you finance, you get a mortgage for $200,000. That's how the math works. So you have that mortgage for $200,000, you pay on it for 5, 6, 7 years, and at some point you decide you want to refinance. And refinance is kind of a little bit of a misnomer. You're not really changing your existing mortgage. What you're doing is you pay off that old mortgage and you get a new mortgage. So it's not a refinance of that existing mortgage. You're actually replacing it. It's a mortgage replacement. So why would you want to do that? Well, a lot of times refinances were done because you get a lower rate. If you buy a house and your rate is 7% and the rates go down to 4%, you refinance. And that's what happened in the 2000s. Interest rates were about 7% or so in the early 10s, 2010, 11, 12. And then rates went down to the 3 or 4% range in 2019, 2020. So people refinanced because you take your same loan, you pay it off with a new loan that has a lower rate. So now your payment goes down. That's great, right? Sure, refinance. You can also refinance to do cash out, and that's what they're talking about, cash out. How does that work? Well, if you owe $200,000 and you decide, I want to get some cash, you get a new loan for $250,000. You take the first $200,000 of that new loan, pay off your old one, and now you have $50,000 in cash that you can do whatever you want with. Buy a boat, remodel, putting on an addition. And us in the building trade, we see this a lot where clients who are doing a rehab or remodel, they do a cash out to get the money for it sometimes. You can also use it to pay off bills. If you have a lot of credit card bills, if you have a lot of debt, you can pay it off because your mortgage rate will be less than the rate on these other bills. So the problem with this news of refinances is that all of the refinances that are happening now, the rate's going up. Right now, the rate for a refinance is about 8%. Sometimes a little higher. If you are refinancing at 8%, you are certainly replacing an old mortgage that has a lower rate because everybody who has a mortgage on their property now has a rate lower than 8%. Because either you bought the house when the rates were 4 or 5%, or even if you bought the house 10 years ago when the rates were 7 or 8%. You have since refinanced when it was cheap, so you have a lower rate. So why would somebody give away their existing 3% mortgage to get an 8% mortgage? Well, the only reason is you need the cash out because you're running short on money. You're out of money. Your bank accounts are empty, drained. If that's the case, you have to do a cash out, even if your rate goes up. The thing that makes this worse is that if you owe $200,000 on your house at, let's say, 3 or 4%, your mortgage payment's going to be about $1,200. If you get rid of that loan and now you cash out $250 at 8%, your payment now is going to be about $3,000. So you just added $800 to your monthly bills to get 50 grand in your pocket. If you needed to take cash out because you're running out of money, you're going to run out of money faster paying $3 grand a month versus, paying $2 grand a month versus $1,200. It's not $3 grand, it's about $2,000. So how's that going to work out? You're just giving away part of your house. So this, keep an eye on this. Growing proportion of cash out refinances. The other piece of information here that we gloss over, denials for insufficient income. Why is that happening? Well, when home prices have gone from 250 to 450 and interest rates went from 3 to 4, people are more likely getting rejected, turned down for mortgages because of their income, not because of their credit. You can have great credit, but if your income doesn't support the mortgage, you can't get approved. So for example, most banks want about a 30% debt to income ratio. So if you make $100,000 and they want you to spend 30% on your house, that's about $30,000 a year, maybe $2,200 per month you can spend on a house. Well, $2,200 a month at 3% mortgage, you could buy a couple hundred, 250, 300 grand worth of house. Well, now fast forward, and 10 years ago that was no problem. You could find a 250 house all day long. Now fast forward to 2023. Interest rate is 8% and home prices are 450. So you buy a basic house, entry level, for maybe 350, less than the average. Average is 456. At 8%, your payment's going to be $3 grand. That's more than that 2,200. So you have to make about 150 now to afford that. Maybe you're going to get denied because you have insufficient income. What's happening with home prices? Well, they're going up. They hit a record high last month. What does that tell you? Remember that real estate crash, housing crash everybody's waiting for? In 2020 and 21, the house prices are going to crash. They've gone up too much. Interest rates are high. A lot of experts think the crash happened. It's over. You blinked and you missed it. They did go down about 3 or 4% in some areas, but now the prices have gone back up. And not just for a blip. They went up for the 6th straight month. So some people are making the argument that the housing crash happened. You just missed it because it happened so fast. Other thing that's important for builders is, it says the resilient part of housing market is cracking. What is the resilient part? Newly built homes decreased 8%. These interest rates are starting to affect the sales rate of homes. Not the price, but the sales. 675,000 units down from 739,000 units. So be aware, this is not the price of new homes. This is just how many are getting sold. Tight inventories of existing homes have pushed buyers towards new construction, but they cost more, so the rates are going to be higher. Payments are going to be higher. So keep that in mind as you're looking at the building industry. They may start building fewer homes. We also saw some news today that new apartment construction is also starting to slow down because of interest rates. There's always going to be a need for remodels, additions, repairs, rehabs, that kind of thing. So the building trade's going to do quite well. However, you don't want to get into the place where you're spending too much because the economy is starting to falter. We're seeing a lot of our retail colleagues in different industries starting to see consumers pull back on purchases or being more skeptical on purchases. We're looking for refunds on purchases. So the economy is starting to get some cracks. Not only do you have rent and mortgage and insurance payments going up, but you also now have student loan payments resuming, which are on hold for the last 3 years. That's going to affect the economy as well because less money will be getting pumped in from people who had excess cash because they weren't paying their student loan debt. I know you have an opinion about all this. Put it in the comments. Let us know what you think.